Hello and good morning, Vernon. Right, so it appears here on the online space we may have a little bit of a sound problem, Vernon, but good morning to everybody. And thank you for joining us on Behind the Markets Friday edition. I am back. Took a little bit of a day to rest and slumber. Good morning to you, Vernon, my brother. Happy Friday, my brother. And let's get started in our catch up and our roundup of how the week is ending. Right. So taking a look at our FX markets, we are sorry, Vernon. Unfortunately, you're not audible. You're not audible. Um, for some reason, we can't hear you at the moment. We'll be working out the sound issues with Vernon just now. I don't know if, yeah, we'll be working out the sound issues with Vernon just now. Um, we do see that yesterday the kwacha did close at about 18.54, which does mark the 74th day of kwacha loss. This being the second highest loss on the second longest streak of losing on the market, and we are seeing that the US dollar has continued. I mean, year to date, it's now up 2.45%. And we are seeing that we are very close to the 52-week highs, and we're trading very close to that. Signals are showing that we are on a buy path, but the dollar is still in a hold pattern and oversold, and we're actually seeing that the growth, the acceleration levels of the dollar are starting to slow down inch by inch. We also seeing now we're also looking at the rand itself, which also had a loss. Now it's going through a bit of a swing. The rand is going through more of a seesaw than a gradual rise up than what we saw previously with the dollar. So we're seeing a little more of a crooked bump up with the rand, but it is in the long term trending upwards. We are seeing the rand up somewhere north of about year to date. We're looking at 0.43% up year to date, and it is trading also a little bit closer, more in the middle of the 52-week highs and the 52-week lows. And we are seeing that it is buying in terms of its momentum, but it's also selling in terms of its directionality. So that one has a little bit more of a mix happening because it's going through the same jungles of movement that we are seeing now. On the bond market, the government bonds on the secondary market are up 0.07%. Do bear in mind that yesterday was the closing date for auction bids. So auction bids did go in for 2.6 billion kwacha. We are expecting interest rates to still be the same. Not much change. We did see one slight signal in the Treasury bill rate, where we did see the Treasury bill rate go down by 0.02 by 0.2% in the last auction. It moved from 15 to 14.98%. One of the first shifts downward in a bit of time, but it has been oscillating around that area for some time. But will that be a signal that we'll see the same happening in the bond market? Not much is showing that the signs are the same. There was a strong oversubscription there that probably led to a slight movement down. We don't have as much of a strong oversubscription, except maybe in the 3-year bond. That's when we're seeing a lot of action has been consistent in Zambia. The 3-year bond, and this one is a reissuance, so it's probably going to be maybe it'll probably be uh, participated in as well. But we're not too sure if we're going to see any movements downwards in interest rates. It's highly unlikely until we get a movement on our debt. Until we get movement on our debt situation as a country, it's highly unlikely we'll see that kind of movement on our interest rates. In the US dollar format, we are seeing that your bond index for secondary trading of bonds is down 1.3%. Remind you, people, that when I'm looking at this index, I'm talking about the people who rate their bonds on current values, secondary traded and current values. Those of you who are holding to maturity, you're not experiencing the same thing. Remember that if you're holding to maturity, your bonds are moving up by about 17% a year. Now, if you're a USD investor, then you probably find that your bonds have probably lost zero value. They've probably remained flat because whatever growth has happened has been counteracted by the FX rate. So what we're looking at here is that we've probably seen less than a 1% loss of hold to maturity bonds during this period. Now, also with interest rates, we are seeing that interest rates are heading closer towards 23%, showing that on the secondary market, there is a little bit of buying action. Now, switching over to commodity markets very quickly, we are seeing that oil is at 86.16. Now, with our currencies swinging around the areas of about swinging around the areas of 18.54 in the interbank rate, one thing we have to bear in mind that we are going to see the effects of the tax hike. Now, there is the expectation that we will see we will see the oil pump price either stay flat or slightly rise. Now, without the tax consideration, this is our calculations here. Without the tax considerations, we are looking at the oil price sitting somewhere around sitting somewhere around 45 and way upwards. While with tax back in, if tax was still in effect, we'd see oil prices moving up about one kwacha at 20 ngwe. So there is an effect that has overshadowed it, and it's simply because oil prices in the last month are up 7%. That's one thing we have to take into consideration. Oil prices in the last month are up 7%. The currency is up about 2.5% year to date. So we are seeing that this combined impact is actually pressing oil prices upwards. And as a result, we don't have much room to play with here. So when you look at when you take a look at oil prices, we are seeing, and let me just pull out where the trends are coming from. We've seen about a 4.24% average change in the kwacha itself, and a 1.09% average change in crude oil prices. And that's leading to a lot of pressure that's building up on the oil prices themselves. So the expectation is that we will probably see a 45 ngwe hike, if not zero. Remember, there's a 2.5% threshold, and this would only be a 1.83% movement upwards. So we'll see what the ERB are doing. This is our mid-month. Estimate, sort of around when the decisions start being made as to what to price the pump price at. So they're probably going to start reviewing this data now. So it's somewhere around 21, somewhere between the 20th and the 23rd, according to a lot of the data that we've been watching when it comes to the ERB announcements, especially this year when they'll be doing monthly reviews. We've been seeing that when we do predictions on the 20th, between the 20th and the 23rd, we start to see they're a lot more aligned. However, when there's structural changes like tax, that can be a little bit difficult to estimate what the impact actually is and where the impact actually lies. So when it comes to oil prices, do expect upward prices. Sorry about that. Now, looking at copper prices, we have seen that copper is currently trading at about 9,305. We're waiting to see output figures when it comes to copper. Copper is currently trading at about 3,005, and it is up. Copper prices are up on the date. So they were down yesterday, but they're still up year to date. It's been a strong-ish copper rally. And what we're seeing right now with copper is that that was down 0.19%, but up year to date 11.15%. So there's been a strong January copper rally on the resurgence of China coming back into the economy. China floating back into the global economy. We are seeing even on the week it's up 1.3%. And similarly, we're looking at gold as well. Gold domestically or gold globally did actually move downwards, did actually move upwards yesterday, and we're actually seeing the same when it comes to gold in kwacha. So most of our commodities now are still trading at a relatively strong position. Now, taking a look at some of the news that is actually affecting some of the commodity markets. When you're looking at news coming out in the oil sector, you are seeing that obviously there's a lot of optimism when it comes to China based on the Lunar New Year. So that's what's driving a lot of the optimism in the oil price and pushing it up. And it does also say oil up as bulls push back against another big dollar crude buildup. So oil, there is a lot of optimism based on China. There'll be a few signs of oil retreating, but in general, oil is pushing up, even though there does seem to be a buildup in oil inventories in America. Now, that also has an effect. There's also the fear of a recession coming soon. Remember that there's a predicted mild recession coming around the world this year, so everyone has to brace themselves. But it appears that the world may be so prepared for a recession it might just fly by. But we should never take a recession for what it is. It could be a very bone-crunching recession if we're not careful. But remember, the banking sector in the US is much stronger than it was in 2008, and this will lead to the recession actually being cushioned. So bank stress tests have been done very well. The actual place where a lot of the debt is being held is in the central banks of the economy. Now, looking at copper as well, there's obviously Chinese optimism does spill over into copper prices. And you do see that copper does hold very strongly as well. You also see that copper prices trading at about 9,300, are much higher than where they were in the second half of last year, especially after we had that Russia-Ukraine war kick in and copper prices dropped off those all-time highs of 10,500. Now they started to come down. So even most of the data is going to show us that there is a real estate problem around the world that will actually affect the outlook of copper in general. Now, if you start to look also at the gold market, the same thing. Recession fears are actually starting to kick in, and this is why gold was up 0.28% yesterday. So people are worried that there is a recession, but remember, gold is more geopolitical than it's more geopolitical and black swan than it is inflation. So I think everyone should always take your eyes away from gold being the inflation hedge. Just look at it when it comes to recessions, and look at it when it comes to global geopolitical conflict that makes people start to rush to gold when things are fearful. Now, there are a few pieces of news. Apologies to everyone. We have had a few sound interruptions, and we probably will have a few more of those. Unfortunately, we just have a little bit of a technical glitch. But back to it, we did see the World Wildlife Fund propose a debt for nature proposal to the government of Zambia for debt restructuring. We did see a debt for equity proposal, sorry, debt for nature proposal. What that simply means is that with some concessions regarding conservation and maybe supporting some of the land being conservative, they might be able to raise some of the capital to be able to now buy off some of the debt. This was a wildlife proposal that is being considered right now with the timing of Ms. Georgieva's visit to Zambia, to IMF MD's Georgieva's visit to Zambia, which is coming at the same time as also we're also getting Janet Yellen. So we're getting quite a lot here. Now, Zambia received a debt for nature swap proposal for part of its $13 billion debt discussion, a move that, while complex to secure and not part of the talks, could set an eco-friendly precedent to the debt crisis eventually. I'm just reading some of the article here, and it says Zambia has become a complex test of the common framework. Now, now, in light of this, it did state that our Minister of Finance and National Planning had received a debt for wildlife proposal considering debt for nature swaps. And what that simply means is that the protection of our animal, the protection of our wildlife sectors, the protection of a lot of our areas, protection of our nature may be part of the conditions of making sure that we can protect debt. Now, this is a way to kind of get it cheaper. And this is why I said environmental based funding can be stronger, but it also comes with strict standards in other areas. So here's the issue I always say to as many of our people as possible. And as much as it's wonderful and it raises funds to be environmentally friendly, we also have to remember that one of our biggest scourges, the number one risk, the number one issue to this country is poverty. I'm not saying we should go around destroying and hacking the environment, but we should never get into a situation where we dismiss poverty alleviation in terms of, and I mean actual poverty alleviation, not putting people on food programs and handout programs. I mean actual poverty alleviation, such as jobs and businesses. Those are the only things known to alleviate poverty: jobs and businesses. Okay, that's what alleviates poverty. Not handout programs, not food programs, not support programs, not poverty research studies. Food, jobs and businesses. So we must not hamper jobs and businesses. We should have a win-win approach when it comes to this, where we protect the environment and we grow the jobs and businesses of this country so that the people of this country have somewhere to work and wealth to build on. That is something that we should never ever forget, is a critical point, because when you are a poverty-stricken nation, that is your number one focus. Okay, so that's what we also have to look at now. This can be an option, so I hope those who are writing it, because unfortunately I know global woke environmental activists are not really that great at thinking about the practicalities of life, but hopefully this is written with the practicalities of life and ensuring that, yes, while we can have more people, we can have more conservation activity, we should still be able to have a lot more people having economic activity, and the two should be able to work in harmony. I think that should be the most important factor of it all. And we shouldn't actually get rid of that, because tourism also is an important part of our life. But yes, there is a proposal that is being considered right now. It is not the main thing, but it is being considered right now as conservation for that now, and also to work within the common framework. And this is just some quick I think this is just some quick notes on debt debt for nature swaps since the late 80s. Since the late 80s, they have actually been utilized. So this isn't a new thing. This is something that actually has been done before and actually has got a track record. So it is something to look out for. In fact, last year was one of the years where we saw Belize get the biggest debt for nature swap, $500 million worth of debt for nature swap. So there have been stories of it starting from Ecuador in 1987 all the way to Belize. The second highest one was Poland, who got one in 1991 for about $400 million. So you can actually get your debt bought out by the environmental lobby. It's not impossible. And you are seeing that it is possible. But our debt situation is so dire that it would be much bigger than any of the previous debt for nature swaps that have ever been done. Okay, it would be much bigger. Right. Taking a look at another story that came out yesterday when we're looking at the markets. And just looking at this, when we're looking at the markets yesterday, we did see yesterday in Reuters that updates from Davos are saying, and this was the World Bank stating, that Zambia needs desperate debt relief under the challenging common framework. And yesterday we did read that this was coming from the World Bank group, who said Zambia needs desperate debt relief, and the argument under the G20 common framework restructuring vehicle are proving difficult. Okay, so this is not good, by the way. This is sentiments coming. The World Bank's managing director of operations said on Thursday, in the last 2 weeks, we have seen the limitations of the common framework. Axel van Trossenberg told a panel at the World Economic Forum in an annual meeting in Davos, moderated by Reuters editor-in-chief Alessandro Gallion. And basically, this is saying that the common framework is bumping into issues right now. And this may be the reason why they're actually having meetings. This may be the reason why we're seeing two groups of people coming here now, because the common framework is actually starting to reach its stress. Remember, people, Zambia is the test case of the common framework. Okay, Zambia is the actual common test for it. Zambia has become the test case of the G20-led common framework, which was led at trying to make sure that China, one, exposed its debt and handling the new dynamics of the global debt situation, restructuring vehicle launched in COVID-19 to streamline debt structuring efforts in the poorer countries buckling under the fallout of the pandemic, and it aims to include non-Paris Club members such as China in debt relief efforts. Remember, the goal was we actually got China to sign on to an international doctrine regarding debt. That's a big thing, and that's a big win that the world is looking for. And that's why, to get as many countries, remember Zambia, one of the reasons America is backing Zambia so strong is that they're trying to get as many countries to sign on to the G20 common framework. So the success of Zambia will lead many other countries who have borrowed heavily from China to then sign on to the G20 common framework, and then make China basically operate under to get China to sign on to the G20 common framework of all of its debt, and therefore to get China to work in an open fashion when it comes to debt. So that's why they're heavily invested in this. But that is a big story that is showing that debt negotiations are not looking so good. So for our domestic bond investors, that's a little bit longer of a window. Remember, as long as our debt are not negotiated, the country risk premium sits at 20.71%, meaning whatever the rates that people are getting in other countries, they're expecting 20.71% more rates of return, meaning that if the US bond market even drops down to 2%, that 20.7. So the biggest chunk of interest rates that we're seeing from the offshore investors, one is the domestic problem they're facing with interest rates. Sure, that's contributing about 20% of what they'll expect when coming to Zambia. But 80% of the problem is coming from our debt restructuring. So we need to as long as we're seeing this dragging along, the opportunity for the local investor to continue piling in. This means that meeting that first quarter deadline might be, not saying it will be, but might have a little bit of a hampering. But that just means pile in while you can, drum in as much as you can, and keep ongoing probably until we get this, so that as inflation is subdued below 10%, or at least held within a certain range, you still have bonds that are performing at 18.6%, 18.3% return on investment during that period. That is my advice to you. With high inflation, rising growth, yes, but high inflation, it is a time to still hold those securities at the moment. So that's a bit of the news breakdown. And one other piece of news that came out yesterday, functionally, was the story from our energy provider, who has stated that load shedding, thanks to Mamba Collieries coming back on, has now been reduced from 12 hours in two chunks of 6 to 8 hours in two chunks of 4. So the average person in the average business will be expecting 4 hours off, 8 hours on, 4 hours off, 8 hours on. So a lot of businesses are actually going to have to structure their time, but it will require that our power provider sticks to their schedules probably as much as possible, especially for those who are trying to schedule their business cycles around it. But then a lot of people have just gotten backup power solutions, and that's what's happening right now in this country. I don't see this problem ending anytime soon. And in all honesty, because it just breaks down to the point of investing in the market itself. Somebody has actually so I'm just trying to make sure I capture notes here from yesterday. It says, Munyumba, please, I'm just trying to read here. Yes, we will be doing more notes on legacy, on wealth building today. We will be doing more notes on wealth building today. I'm actually pulling up the financial matrix for age 40 to 50. What should your life be from age 40 to 50? Just finishing off, obviously, our news roundup. We are seeing, as we said, the announcement that load shedding will come down, so it will not affect business houses as much. So at least we've gone through January, and we've gone through the 12-hour load shedding cycle down to the 8-hour load shedding cycle. It's broken into two chunks of 4 hours, which truly is more manageable. 4 hours is much more of a manageable load shedding cycle than 6 hours, 6 hours on, 6 hours off, 6 hours on, and way more manageable than the 12 hours that were just thundering us with at the beginning. So I think we are seeing a much better management system here. Now, hopefully they'll keep it up, and they have been very transparent at this point. Here's my issue. I know I made a smart comment, and I made a smart mouth comment yesterday where I said it's amazing how it floods everywhere except the Kariba. And I got a few snarky engineers coming saying, we are trained hydrologists. Here's my problem with the trained hydrologist groups and the trained engineers groups. And this is not a dig at everyone. It's at everyone who's a professional who's trying to open their mouth, telling us to keep quiet. Where were you when the water levels were dropping? That's the question everyone is asking you right now. If you're going to start saying, we are the smart ones, listen to us, we are the smart ones, where were you when the water levels were dropping? I'm here telling people to watch out for oil prices that could go up. I'm here telling people to watch out for where the currency directions go. We make predictions every single time. We get some of them wrong, but we make predictions and we try and help people make forward-guided investment decisions. We look at where the stock market is probably heading to. We look at where the bond market is probably heading to. That is what advisors do. So if you're going to stand here and tell us to keep quiet because you have the degrees and you have the professionals, could you please kindly also warn us when the water levels are dropping? Because if you're not going to be able to do that, you have no use only being smart when the water levels are gone. Okay? Because I want to know why I didn't hear a single engineer tell us that the water levels are dropping in this country over the last year. And then all of a sudden this year, you're all the intelligent ones we have to listen to. We must listen to the professionals. Where were these professionals when the water levels were dropping? A child can see water levels dropping, okay, in a cup. Can we please have people who are smart? If you're going to stress your 4 years of education and your years of education, could you kindly use them to help us as a country so that we can also make plans? It's not just about trying to argue with the president and everything, and it's not just about trying to argue about politics. It also helps the people themselves know that, okay, we're going to have a load. We're actually at a warning level. What would be nice going forward is if we could actually maybe put in Zambezi River Authority monthly reports into our Zambia Statistics monthly report so that we understand where we are. Where are the load shedding points? Where is load shedding level 1 point when it comes to the Kariba? Where is load shedding level 3? Where is load shedding level 4? Where are they and where are we now? We as people will be able to interpret that and say, wow, okay, I think we need to try and do that. We need a lot more open information about things like this for planning purposes going forward. It would be nice to do that. Okay, so I just think that we need to be able to know, we need to be able to manage the situation better. So it's not a dig. It's not me trying to dig. It's just me trying to say one of the reasons Zambia goes through cycles that we call populism versus professionalism. Okay, one of the reasons we go through this stuff is because don't professionals, and I'm talking about in finance, I'm talking about in engineering, I'm talking about in health. Professionals like being smart when problems arrive, but they're not smart to try and help us get away from them. Okay, and professionals don't like being useful to society, but they like being highly paid. And this problem creates resentment at the bottom rungs of the economy, where people now lash back and put populists in office who make everyone suffer. Then the economy fails and we go back to the professionals. Then the professionals become snooty and arrogant again. Then the inequality builds, resentment builds. They go back to the populists and back to the professionals. This creates policy instability in our country. So we need to improve the policy stability of our country to make sure that we are able to chart a proper path of development. And in order for us to do that, professionals need to start learning to be useful to society as a whole so that you gain the trust. Because I'm telling you right now, engineers, I'm warning you right now, you are going down the route that bankers, lawyers, and politicians are. Okay, you're going down that route where the majority of them have lost trust in society. Right, because they have been self-serving for a long time. They have lost trust in society, and right now you're teetering on the edge of joining them. So you have to be very careful. You're still trusted in society, and to remain trusted in society, you need to make sure you protect that trust. Even us in the economist field, we had a rogue leader of our what's it? We had a rogue leader of the Economics Association who decided to become a politician at the same time, and he sullied the name of economists around the country. And we have to work hard to gain that credibility back, because professional credibility is very important in being able to guide society. So before you start telling me how many degrees you are and how long you studied at UNZA, perhaps do that. Perhaps tell me that when the water levels are dropping before load shedding, start to say, people, we need to warn you, start prepping. There could be load shedding around the corner. That's what we want to start seeing from the people in those fields if you want to get the credibility of the people. Right now, trying to tell us you're this educated and that educated, good luck with that. Now, let's but the news cycle does actually help with load shedding. So I would really, what I am trying to say is professionals in all fields, be useful to society, not when the problem happens, but before the problem happens. You'll gain the trust of society that way. Now, let's take a look at, as I was saying that today, I wanted to close off on the financial planning matrix. So to everyone who's here with me, thank you for joining us. Let's actually go into the final part of the financial planning matrix. And I always ask, for those who are watching on social media, please give me the writing signal or the note-taking signal to know that you are here with me taking notes. So I will be going through those of you who are, if you're 30 and you're trying to look at where you should be in your 40s, take notes. If you're 40 and you want to know where you should be, take notes. And if you're 40 and you want to know where you should be when you're 50, take notes. Okay, so we're talking about the financial planning matrix when we're age 40. And remember, I'm covering cash flow, I'm covering risk management, I'm covering debt management, tax management, and estate planning. These are the areas you want to look at. So when somebody hits 40 to 49, they generally don't feel broke anymore. Okay, most people, when they hit 40 to 49, they can be financially stressed, but it's usually because they've got mountains of issues to deal with. But they're not trying to deal with bread issues. Okay, that's what they're not dealing with. They're not dealing with bread issues and putting 20 kwacha of power in their meter to try and make it to the next day. Their issues are a bit bigger. So one of the things that you have to stop doing in your cash flow management, and as I said, just give me that signal that you are taking notes, because this is a time to take notes. Remember what we said. If you don't take notes, you do find yourself in a tough situation where you will forget. Okay, so you want to stop moving the goalposts the higher your income gets. This happens a lot with people. No, I'll start saving when I get to this much. I'll start saving when I get to this much. I'll start investing when I get to this much. I'll start, all of a sudden, as the numbers keep rising, the goalposts of when you'll start doing the good habits keep rising, because you're not building the good habits anyway. You're supposed to build the good habits regardless of your income status. So there's a behavioral matrix that we will be going through also for people to match themselves at. So if you're 40 to 49, you're at what we call the fork in the road. This is where this is where your retirement is very good or your retirement is very bad. 40 to 49 is the determining point that a lot of people face. So if you're 30, just know that 40 to 49 is your fork in the road point. If you haven't built up enough and done enough there, you can still make it, but you have to be very careful, because at this point, things are non-negotiable. So know what makes you happy and stick to it. At this point, you got to stop chasing trends. You got to stop chasing hype. You got to stop looking for people's approval. You've got to know yourself what makes you happy. The reason is this: happiness is actually what controls a lot of people's spending. People spend for desires. They spend for happiness. So your financial decisions are often driven by your happiness and your meaningfulness as a human being. But you need to know what makes you as a person happy, not still trying to discover it. 40 to 49. So if you're trying to figure yourself out in your 30s, it's time to understand that you need to know what's going to make you happy in your 40s. Know your why in life. Why are you alive? What is your purpose? What is your main thing? Remember the 3 L's that I talk about: your legend, your legacy, and your lineage. You got to work that story out already. Okay, this is a must. By 40 to 49, you need to have a clear picture as to what your legend, your legacy, and your lineage are in life. And that will now drive your decisions. And at this point, 40 to 49 is the time to start considering what charitable giving that you're going to be doing, what charitable support. Now, I'm not saying be the blesser. I think this is not about trying to show yourself as the blesser of society and ankundarama at weddings. That is not what we're trying to say. We're trying to say, what are the things that are close to your heart that you want to do something about, that you want to try and support? So that's important news that you want to try and look at. Now, let's take a look at your risk management. Your biggest risk at this point, your 2 biggest risks are your life ending because people are dependent on you at this point, and also your health. So because healthcare becomes your biggest expense in retirement, and you don't want to spend the majority of your wealth that you have built up handing it over to hospitals and doctors, you really want to start becoming health conscious at least by 40. 40 is that cutoff point. Usually, and I do even think that 30 years is actually a time to really, really be stern on your health. The reason is you don't want to start building up these chronic illnesses. There are lots of guys our generation who now have very chronic lifestyle illnesses, and it's a lot of stuff that wasn't taken care of in the 20s, where there was a confusion, and then all of a sudden by 30 you're starting to get sick in ways that we only were associated with people who were 60. Okay, people are having 60-year-old illnesses when they're 30. So really, you want to start watching out for this, because 40, you really want to be super health conscious, because the decisions now are really going to affect your life at 60. And this is where the point where a lot of stuff gets irreversible, almost irreversible. So health consciousness is really important at this point. That helps you. So being health conscious helps with your financial decision making. Now, let's take a look at your 40s in terms of debt. When you're dealing with debt, consumer credit is a huge issue. Okay, at this point, you're trying to buy things on credit, furniture on credit, so much on credit. Avoid it, because this is now eating your ability to make your final last legs here. Consumer credit is not a great thing just in general. Or you want to make sure that if you're going to take consumer credit, it should be paid off within 3 months maximum. Don't roll it over. Borrow for things that you can pay for by the end of the month. If it can be per month end, yes, but also don't live life on per month end. Now, don't allow that life to build up on you. Okay. Car loans, you know the calculations for car loans, 3 to 6 months of your income. Don't try and get away from it. And home loans, you know the calculations for what value of home you should be owning as well. You shouldn't own a home more than 25 times your annual income. That is a calculation that we've put out there as well. Expensive kids' schools are where debts really become very dangerous. Now, when I say home loans, by the way, it's being 25 times your annual income. Do not, okay, and I repeat, do not do not do as in also do not forget the interest payments. Do not forget the total interest you'll be paying. So your home loan, in terms of your home purchase price, whatever you're purchasing, should be equal to a certain amount. So look at the calculation of what value home you should be owning. Now, expensive schools for children. This is where a lot of people get hit badly in their 40s to 49. You're trying to make sure that you send your children to expensive schools. Don't do it by indebting yourself. If you can afford to send your child to a good school, cool. Do it within your budget, manage it well, but don't bankrupt yourself doing it. And also, business debt. This is one that hits people a lot badly because you don't have much time. When you're in your 20s, you don't have much time. 60 is 20 years away. When you're in your 40s, 60 is 20 years away. So you want to remember that. Now, also, when you're in your 40s, what you want to look at when you're doing financial planning is don't fight with tax authorities. I'm telling you this right now. Don't lose your wealth fighting with tax authorities. Don't try and get around them. A little tax planning goes a long way, saving over a little period of time, because you don't want to build up all that wealth in life and have it seized by the tax authorities because you didn't want to manage your taxes. Okay? So really, and then look at what are tax advantage investments. Try and start looking. I would advise you to also keep a column of tax accounts. Keep it on your budget. How is your tax account doing? How many payments are you making? Are you up to date? You want to keep up to date also with taxes so that you're as compliant as possible. And now when you're looking at your 40s, at 40 to 49, when it comes to estate planning, you want to do advanced planning in life. And finally, you also want to look at financial education for the next generation and your beneficiaries. So your financial education plan should be airtight now, because your kids are heading at this point. You probably got married or had kids in your late 20s. You need to make sure that you're somewhere significant when it comes to planning for your your kids' savings plan. Look out for what are the premiums that you're being asked for by insurance, and also now calculate if you were to save on your own, and make sure that you're getting the right price and you're getting the best bang for your buck. What life insurance components does that savings plan have for your kids in the event you were to pass away? That there should be a life insurance component that kicks in, handles the balance, and your child's education is still managed. So you do want to have some form of a life insurance component attached to you, so that your child savings plan is managed in a way that your child savings fund. It would be good as a country if we did have tax advantage plans for parents to start saving for their children's education, to encourage saving for education, as opposed to trying to get people to get onto student debt. That would also be a good simultaneous policy that we should be working on, so that in about 20 years' time, 10 years' time, we're seeing more children, the ones who can be funded by parents, being funded by parents, and those who really need it, then they can get the support. And maybe we can start bringing down the student loans for people and not being so stressed in our system. So that is age 40 to 50. We'll be talking about getting to 50 on the other side on another time, but we are out of time. But we'll be looking at where life sits in age 50, so that you can make good decisions for yourself and for your family. Sorry, let me just put this down for everybody. I think I made a little bit of an error here. Your home price should be 3.5 times your annual income. Sorry, that number was incorrect that I gave you before. 3.5 times your annual income. So whatever home loan you get or home you want to buy, calculate your total income that you get a year, multiply it by 3.5, and that's how much you should be expending on a home, because that is probably the kind of home that you'd be able to finance. And that's what I wanted to put out there. So to everyone, have a wonderful and blessed Friday. We will be seeing more of you, and follow in next week, because next week I will be now traveling. I'll be finishing, obviously, what 50 to 60 looks like. And I want to be talking about investing by age, what we should be talking about in terms of investing by age. And I have been told you can go I've been told by our tech team to actually go on a bit. So I will be able, sorry about that. I will be able to now give you the age 60. I will be able to give you what life looks like between age 50 for those who are trying to do retirement planning. And here's what I'll say very quickly for those who are in age 50, period. But I just wanted to tell you again, remind you that the home you want to purchase or the home you want to build, the reason why, by the way, I also say that stuff about home prices. The reason why I say your home should be 3.5 times your annual income, the reason is that your home has costs. It's got tax costs. You pay about 0.1 to 0.2% land rates on it, or you pay rates on it, sorry, on the property, not land rates. You pay rates on the property to your local council. You have to maintain it. There's maintenance costs. You should be able to manage 5% the value of your home in monthly maintenance costs. Because when things break, you don't have a landlord to tell anymore. You have to do that. You also have insurance costs. Okay, you have to be able to insure your home, and all risk insurance is about 3%, because you don't want to spend all your life building a home. One day it catches fire and you lose all of it already. So there is, in as much as yes, you can afford all this. Can you afford to maintain? You can afford to acquire something. So always remember the three R's of responsible ownership. It doesn't. The third R doesn't match for home, but the first two do. It's risk, It's risk, repair, replacement. Please, somebody write that down in the comment section if you can. Risk, repair, replacement. If you can hear a train moving in the background, yep, welcome to our country. There's a train that moves here. Risk, repair, and replacement. So write those three down. Those are important ones. Now, and when it comes to home ownership, risk and repair. These are costs of home ownership that you need to be able to adhere to. And then there's taxes that you actually have to pay. So you have to be able to manage that. Then obviously there's utilities and those things, but even renters deal with that. But in terms of being the homeowner, you have to be able to pay the taxes, you have to be able to repair it, and you have to be able to manage the risk in the event something happens to your home, natural disasters, flood, anything. You should be able to manage that. Okay, very carefully. So that's something I just wanted to just point out to you when it comes to home ownership. That's a good basis. Now, obviously, it's a hard and fast rule, but yes, most people are lost when it comes to those things. Now, when you are in your 50s, one of the things you want to avoid is economic care for kids. So you want to avoid having children in your economic care, because that is usually one of the ways to lose money. Having people who are staying in your life for too long. And by the time you are 50, you must, and I must stress this, you must be debt free. No payments should be getting made. At this point, you want to have long-term insurance care, and you also want to consider life insurance. You want to consider a little bit less of the life insurance, because I ain't got much life to give anymore. But I know we always talk about life insurance as one of the things. But yes, at this point, when it comes to risks, you want to make sure that you got long-term care. You want to be debt free when it comes to debt, but people in the 50s are still carrying serious debt. One of the biggest debts that people don't watch out for in their 50s is one, children's wedding debt. When you get into your 50s, your children are getting married, and people go into debt to try and make sure that they have the flashiest wedding, because it's a moment. It's a single moment we have to. Yeah, but poverty is a serious issue. So your moment doesn't matter when it comes to the issues of poverty. So avoid going to debt for your children's weddings. Okay, that's the big risk that we're looking at. And also children's college. You often find people liquidating their pension funds because of their children's college. So 50 is coming, people. You want to get to a point where you can actually finance your children from the savings fund that you built for your children in their 50s, in your 30s and your 40s, not trying to liquidate your pension, because there'll be no time to recover back from it. Assets must sit in as much tax advantage. What other places where your money can sit that it's tax advantage? And key tax milestones, you want to start to watch out for where you should be in terms of taxes. Okay, because this is the point, like I said, where wealth can be taken from you because you mismanaged dealing with the tax authorities. And then you want to make sure that you look at your beneficiaries very well. You need to, when you're doing estate planning, at this point, you're at the point where you're in the final leg of life expectancy. Anything can happen to you. Who is to assume your NAPSA if anything happens to you? Who is to assume, and if you're not already collecting it, who is to assume your property? Who is to assume your bonds? Who's to assume your stocks? Who's to assume your pension if you haven't collected it? You want to make sure that it is known where the stuff will go, because it's very important. And also, what institutions do you want to leave some of this behind to? Do you want to leave part of this to your church? Do you want to say, look, in as much as this is my pension, in my will, I'd like to put this. You must have a will, people, at this point. Okay, when you hit 50, you must have a will that you're renewing every single year. If you have no will, you are literally leaving it at the whim of society, and you are leaving it as something you cannot trust. So that's a bit dangerous for you. So I think that's what I wanted to put it for 50. So this is where you're supposed to be in life. So if you're 40, you want to look at these 50 points and say, okay, this is where I need to be, because I'm planning on retiring somewhere at 55, going into 50, going towards 60. So you have to prepare for the next stage. So the purpose of the financial matrix, I'm going to say this again, is not for you to just know where you should be. It's to know where you should be and to know where you are going. One, am I where I should be? That's the first question you want to ask when you're dealing with the financial matrix. Number two, am I on track by the time the next decade of my life comes? Okay, so if you found that very useful, please give us a like, give us a comment at the bottom. If you managed to find that very useful, share this with people, and hopefully we can get a lot more of this going early as we're going into the year. You want to try and make sure you are on a plan to catch up with where you're supposed to be financially, and therefore you're looking at your buckets of wealth. We'll be looking deeper at all this stuff next week. Thank you very much once again to everyone and to our tech team for granting me an extra 10 minutes. Thank you, guys. It's often a gift. And for everyone, we thank you. Have a wonderful weekend. Have a blessed weekend. See you on Monday. For those who are checking me out on God's Economy, see you on Saturday. Have a wonderful day.